Hi guys and welcome. In this video, we're going to discuss credit builder loans. What are they? What are the types of credit builder loans? And how can they boost your credit? And where can you get the loan to build your credit? You could say that a credit builder loan is like manna from heaven for people who have poor credit or have little or no credit history. But why is that? It's because this loan will help them build credit. Then if they're able to get good credit scores later, it will be easier to get a credit card and they are more likely to be able to negotiate for a better interest rate. What makes credit builder loans unique is that they do not require good credit for approval. However, the lender will require you to have much income every month such that you can afford the monthly payments. When you borrow money, the lender will hold the amount you borrowed in a bank account while you keep making regular payments. They will report your on-time payments to the three major credit bureaus, Equifax, Experian, and TransUnion. Since they calculate credit scores from the data that come from your credit reports, making on-time payments will have a big positive impact on your score. So, what is a credit builder loan? Perhaps to many borrowers, the hardest element to build good credit, whether from the ground up or repairing a bad credit history, is patience. You'll need ample time to show lenders that you are a trustworthy borrower who makes on-time payments regularly. A credit builder loan could be the best way to jumpstart your journey to good credit history. Here's how it works. A financial company, such as a credit union, that normally issues credit builder loans will first deposit a small amount of money into a secured savings account for the borrower. Once the money is in the account, the borrower begins paying back the money in small monthly installments over an agreed period of time. Of course, the monthly payment will have an interest component. At the end of the loan's term, which normally ranges from 6 months to 2 years, provided the borrower has paid off the loan, the bank releases the money to the borrower. The borrower will receive the money in a lump sum plus any interest earned if the lender pays interest. A significant benefit will accrue to borrowers who will be able to pay their monthly obligations on time. Lenders will report the payments to credit reporting companies, and this data will go into the borrower's respective credit history. Eventually, they will begin to build a solid credit report because of this information. A credit builder loan helps individuals build their credits by providing them with an opportunity to show their credit worthiness through small monthly payments. As they make their monthly payments on time, the lenders will report these regular loan payments to the credit reporting agency. By doing this, the borrower's credit history will show that they can make consistent, on-time low payments until they've fully paid off the loan according to its terms. Next, let's see what it does to the credit scores. After a borrower has started building a credit history and established trade lines in use, he or she begins to develop their credit score. FICO and Vantage Score are the two most popular measures, and both range from 300 to 850. Of course, any borrower would want to target a higher score because it shows a long and positive history of responsibly using credit facilities. Naturally, when building your credit score, you will have to start from the low end. But after a year or so of borrowing and patiently repaying your loans, your numbers will begin to rise quickly. In terms of scoring, the two most critical scoring factors are your payment history and your debt utilization ratio, which is the amount of actual debt over the amount of credit that you have. However, the length of credit, the types of credit in use, and pursuit of credit are also important factors that go into your score. There is no shortcut because you can't speed up the terms of the loan, but you could get several loans simultaneously to show that you can well manage multiple accounts. But a word of caution, apply for only credit that you're somehow sure you can get, because hard inquiries that will result from your loan application will pull your score down. Credit builder loans are characteristically small and range from $5,000 to $2,000, so a borrower could easily afford small monthly payments. However, interest rates will still vary from lender to lender, so it's always good to do some scouting to get the most favorable rate. You might find rates as low as 5% per year as all the way up to 16% at different banks. Applying for a credit builder loan is quite easy. A borrower can simply just go to a local lender's branch to apply or file for an application online. Since the lender won't release the actual funds to the borrower until he pays off the loan in full, most borrowers can qualify for a credit builder loan in a flash. There are different types of credit builder loans. Basically, credit builder loans fall under two types: pure credit builder loans and share secured loans. Pure credit builder loans achieve two important objectives for the borrower: It helps a borrower put up a savings account while building up credit at the same time. The lender puts the entire loan proceeds in a savings account under the borrower's name, where it stays frozen until the borrower pays off the whole loan. The borrower does not need to make an initial deposit to the bank, but he has to make the monthly payments until the loan is paid off. Afterward, the money goes to the borrower, and he can use it as the deposit on a secured credit card. More importantly, the loan history goes into his credit report and becomes a good entry to help improve his credit score. This strategy has many other uses, such as building savings for a down payment for a car. Adding good entries into your credit history will improve your credit score over time, and once you have a more ideal score, you could haggle for a lower interest rate on an auto loan. In a share secured loan, the lender uses a savings account as collateral for the loan. The borrower has to deposit a sum of money into a savings account. The bank will freeze the funds in the account and unfreeze them commensurately to the loan payments that the borrower makes. Why would someone go through all of this trouble? Basically, this scheme is very good if a person wants to improve credit mix, which is one of the factors in determining a credit score. Although it would result in only a modest increase of around 10 points, it is good for someone whose score only needs to be a few points from fair to good. For them, the slight difference between the interest on the deposit and interest on the loan is worth going through the process. Credit bureaus pay attention to revolving credit, like credit cards, and installment credits, auto loans, mortgages, and personal loans, such as a share secured loan. If a borrower only has credit cards on his credit history, a share secured loan would help a little bit. Take note that it will only be a small uptick because share secured loans are normally small, short-term loans. Creditors will now be more open to lending you money because you have shown that you can handle month-to-month payments. They are ideal for consumers who want to start a credit history or someone who wants to repair a damaged credit. Now, let's see how you can get a loan to build credit. Credit builder loans can be an easy way to build or rebuild credit, but they are not the most common. It would take some effort on the borrower to find a lender that offers one. But since they are a secure, safe means of improving a credit score, they're worth going to great lengths to find one. You may look for a credit builder loan at the following. First, credit unions. Credit unions offer the same line of products and services like a traditional bank, but they are also a nonprofit entity. Plus, they offer other services, including credit builder loans. They will also keep the money they lend in an account until the borrower completes the term, which is anywhere from 12 to 24 months. Their interest rates are slightly lower than with other unsecured loans, and many credit unions put the funds in an interest-earning savings account, so that also helps a little. Local banks would also be happy to supply you with a credit builder loan. Most national banks do not offer credit builder loans and will often suggest that you get a credit card instead. You might have better luck with a local bank that can offer a personal loan that you secure by your funds until the end of your loan term. At the proper time, you can choose to withdraw the total amount you've saved or keep them in the bank as a nest egg. It all depends on what you think will be of most financial benefit to you and your situation. Last but not least are online lenders. The good thing about online lenders is that you can rebuild your credit without having to actually leave your house. Businesses such as Self-Lender work through banks and give out small loans that borrowers can repay over a year. You need a certificate of a deposit to secure your loan until it's paid off, while in the meantime, your lender reports your payment activities to the 3 major credit bureaus. However, there are other ways to establish good credit scores aside from getting a credit builder loan. Here are some of them. The first thing you can do is to apply for a secured credit card. A secured credit card works in the same way as a credit builder loan in the terms of trying to build or rebuild credit history. The application process is practically the same, except that issuers of a secured credit card will require a deposit of around $50 to $300 into a separate account. The bank will issue the borrower a line of credit that's usually equal to the amount in a deposit. This way, the borrower can build a credit history without exposing the lender at risk. Some credit card companies will allow their borrowers to graduate and level up to a traditional credit card after they've proven that they can meet their monthly payments religiously. Lenders will report your payment history to the credit reporting bureaus and, as an added service, will offer autopay, online payments, and alert notifications to make sure you don't forget to pay on time. These types of cards are not always free. Some will require that cardholders pay an annual fee and agree to a high APR that can sometimes go as high as 25%. Another option to build your credit is to get an unsecured personal loan. There are unsecured personal loans that borrowers can easily qualify for to help them build credit. These are small to big loans, ranging from $2,000 to $50,000 that lenders make available to borrowers with lower credit scores. The lender will release the money to the borrower up front, and if the borrower has the proper financial discipline, he can use the same funds to repay the loan, since its purpose is primarily to build credit and not to source for extra spending money. This path to building credit is a little risky and a bit costly. Many lenders of unsecured personal loans charge origination fees and interest rates that can run up to 36% per year. Looking at it from that point of view, it's an expensive way for an individual to build credit. Joint account holders or authorized users are another option you should consider as an alternative. Consider asking a family member to add you to their credit card account as a joint account holder or authorized user. In a joint account arrangement, the responsibility for making payments would be on each account holder, so that any late payments would negatively affect each other's holder history. Authorized users, on the other hand, are not responsible for making payments, but they have access to the use of the credit card facility. Although both options can be a way to build credit, not all card issuers report authorized user accounts to the credit reporting agencies. Be sure to find out about this before you can ask them to add you to their account. As in any other type of credit, choosing these options means you have to pay back your debts on time through monthly payments or bi-monthly payments. Remember that any late payments or missed payments will have a negative impact on your score. One more important thing, just be sure you can afford to take the extra debt before you borrow. Going into it without doing so could bury you in debt, wreck your budget, and bring your credit score to a worse situation than before. All in all, should you try a credit builder loan? We can all agree that a credit builder loan is a good way to build your credit, but it's crucial that you are certain that financially you can afford it. Compute how the monthly payments will impact your budget, if at all. It's never wise to get any loan that would turn your budget upside down, because it would normally cause you to fall behind on your other bills and debts. This would, in turn, hurt your credit score instead of making it better. Remember that in many cases, you'll be advancing your own money, and you may not get it back for several months or even a couple years. And that would depend on the size of the loan and how much your monthly payment would be. Remember, too, that you will be paying interest that goes to the lender and does not go back to you at the end of the loan term. Using this type of loan will cost you money. It would be a bonus if you can find a lender that will refund the interest charges if you make all of your payments within their due dates. That's it for now. On our website, you can find more posts as well as calculators and other financial tools. Have an experience with a credit builder loan? We would love to know your thoughts and hear your stories, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel on YouTube to get more free financial education videos.